having a plan when it comes to investing in any company, I would say anything actually. So it could be any speculative investment. I'll just be highlighting why it is a must to have a plan. So, finding very good ideas. You might think it is the toughest part, and it is what separates the very good investors from the bad investors or not so good investors. But it is not that hard. I think it is not the hardest part to, uh, you know, just look at the earnings, look at what's working, what is not working in the markets, which companies are getting the bulk of the money flow. That will tell you very reliably which companies to focus on. So once you have those, let's say 10, 20 companies which are doing very well, let's say on the criteria of earnings, of let's say the promoter being driven or having a very good guidance by the management. But the thing is that not all people who find that, let's say, very good stock X, not all of those people make the same money out of it. So most people will actually lose money, even on a very, very strong stock, which goes, let's say, from 10 to 100. Most people, and then back to, let's say, 40. So throughout this journey, most people will not be making 10x. Most will not even make 5x throughout this journey. So a lot of people will maybe get in too late or get in way too early and sell it out before this move ever happens. Or just they'll just be shaken out uh, along this way. So what differentiates is what you do once you find the idea, once you find a very good company which is having a lot of growth, which is doing everything you want it to do. So what you do with that, so how you trade that company is the key. And also being honest with yourself. So let's say you bought company X for reason Y. So if that reason Y is no longer viable, it is no longer in action, there is no reason for you to hold company X, right? But you will find yourself making up an excuse to still hold on to it just because you had a bias that, okay, X should do good, but because of Y. So you can only realize that there is no reason to hold on to X anymore, the company X, if you're very honest with yourself and you're very true to admitting that yes, I can be wrong, or you were not even wrong, right? Had this Y reason played out, you would have been right, and you were right in maybe investing in the stock. But when you have the information that okay, this Y thesis will not play out, it is not likely to play out, then staying in the stock is, I would say, the wrong move. And you don't even have to admit that you made a mistake by entering X, because when you entered X, you could not have maybe known that Y will not play out. So most people, including me for quite some time, have this habit of making decisions as things unfold. So we'll just invest in, let's say, company X, and we will not think too much about what we will do if it behaves in various ways that it can behave in. Right? It can go up and then go down. It can go down and then go up. It can do nothing and then go down. It can do nothing, then go up a little and then go down a lot. So there are many scenarios that can play out, but we think that we'll analyze those and we'll make a decision on all those scenarios as they play out. And this is, I would say, just being lazy, because you don't want to think of 50 different outcomes when you know only one outcome will unfold. So I'll just think of that one when it unfolds, as it unfolds. But the problem with doing that is that you cannot expect yourself to be in the right frame of mind, because let's say you invest in X, company X, and then it just starts falling. So this fall will make you very emotional, and you cannot expect yourself to make a very unbiased or a very rational decision at that time. But had you thought with a clear head at this point of investing, that if this just starts going down, I'll sell it at, let's say, 25% down. So then you would not have to make that call as it was falling. You have made the call right here of what will happen and what will you do in any situation. in most situations that you can anticipate. And you don't have to make a decision with a very hot head. You can make a decision with a very rational mindset without any emotions of price movements, and that can keep you very disciplined. Also, as the stock is falling, you may not have the time to make a very good decision. You might be in the right frame of mind. Maybe you're just not affected by price movements, which I don't think is true for most people, but maybe you are that person. You still cannot expect yourself to have the time to analyze everything as situations are unfolding. It just is not a very wise thing, in my opinion, to do. And of course, this is not financial advice. You can do anything you want with your money. It is none of my business. But this is just the way that has worked for most people that I have read about and have talked to. And it is also something that I incorporate personally. So a very good way to formulate this framework is to write everything down. That let's say I make a trade today. So as I make it, or right before, right after I make the trade, I'll write, let's say, 3 lines describing what led me to make that trade. Let's say I'm selling a stock. So why did I sell it? What was the reason I thought is appropriate for me to take that decision? And how much I sell, uh, what am I thinking about. You can also add, let's say, an emotion that you're feeling at that moment. Let's say you say you're feeling scared, and if you are honest with yourself, you'll be able to write that down. You can analyze that, and learn from your mistake if there was a mistake. If there was not a mistake, you can reaffirm that, okay, this is the right thing to do in these situations. And of course, you cannot know for sure if it was a mistake or not, because for that you need to have a very fixed reference point of what is a mistake and what is not a mistake in the first place. Because simply relying on price, let's say you sell something and you sell it here and it goes down, that does not mean that selling it here was not a mistake. It could have been a mistake selling it at this point. Maybe the reason it fell, uh, let's say the next week, there was no way you could have known about this reason. So basically, there was no reason for you to sell. You just got lucky by selling it. So it could appear like it was not a mistake, but it could be a mistake. And the contrary could also be true. Let's say you buy a company and it just starts going up after that. So when you bought it, let's say there is a news that comes out because of which it starts moving up. So when you bought that stock, you had no way of knowing that news will come out. You didn't know about the news, but you still bought it. So now you can think that I made such a good decision in buying it because the price went up after I bought it. So just relying on price is not enough to evaluate whether you made a mistake or not. There's a lot more to it. So basically, writing everything down, it helps you formulate your plan in the future that you can have, that you can also write down. It can help you, be accountable to yourself. It can help you admit mistakes. It can help you understand the way you think and what biases you have, and all of that. So I just recommend anyone who is investing to, have a plan and to write everything down. So this is just what I think is a good way to go about it. And of course, there is no buy or sell recommendation in this. I don't know how anyone can even, make out a buy or sell recommendation in this video, but if you can, it is not. So that will be it for this video. Thank you.